We now pick up in part 2 of module 5.5 on the issue of binomial convergence. The GBM has a well-known and well-studied binomial alternative. GBM-OVM is a recombining tree. It's based on a binomial lattice that recombines. In the limit, it goes to the log normal distribution. It's multiplicative in nature. ABM has the same sort of features in that it recombines, but it's additive in nature. And so the terminal distribution converges to normal under ABM, converges to log normal under GBM. Either model can handle early exercise with the same relative ease. One issue is the question of what's known as homogeneity of degree 1. GBM is homogeneous with respect to S and X. So a 2-for-1 stock split is automatically handled. So if I doubled the stock price, doubled the strike price implies the call price doubles and the put price doubles. The only difference with ABM is I have to also adjust the dollar volatility. And so 2 times the stock price, 2 times the strike price, 2 times dollar volatility, or absolute volatility, results in 2 times the call price and 2 times the put price. It's not that difficult to address things like splits within ABM. Empirical evidence, this is one of the driving forces that I think finance is an empirical science in many ways. I reject the argument that finance is solely a positive science or an empirical science. It is heavily normative. Value, by definition, is a moral statement at the end of the day, and therefore finance is has a heavy moral base. The evidence for that are the strict codes of ethics found in every single finance practitioner association. For most of my academic career, not a single academic finance association had a code of ethics. Lately, the last decade or so, they've started adopting them. But anyway, finance is often is based on empirical study. And if you look at the time value of out-of-the-money calls and puts, you get this kind of distribution. This is not a cherry-picked particular August 8, 2015. This is just typical. And what this illustrates is an implied negative skewness within the implied volatilities coming out of the option pricing model. So this empirical evidence is model independent. It's not implied volatilities. It is just the time value. And so this higher time value as you go with lower strike prices and lower time values when you go to higher strike prices implies a negative skewness, and therefore a symmetric distribution might be better than one that's positively skewed. If I take the log transformation, I happen to stumble upon this. It's amazing how linear these market-based time values are for out-of-the-money put options, and often out-of-the-money call options are also similarly linear. And so if you fit a slope of these lines, and in theory, if the log normal distribution is the right terminal distribution, if I take the slope of this line, minus the slope of that line, when you take the absolute value, you would expect this line to have a flatter slope and this one to be steeper. This particular graph is a measure of slope difference. Under GBM, you would expect this slope difference to be positive. It is never positive over this entire empirical window. And the 2 standard deviations around this result is obviously not positive. And so this is, in my mind, overwhelming evidence that just on the analysis of slope, that ABM-OVM fits equity option prices better than GBM does. In an analysis of implied volatility, the ABM percentage improvement over GBM is always positive and often quite significant, particularly when markets are stressed in the Great Credit Crisis or the Great Financial Crisis of 0809. And so ABM has significant empirical support. One rebuttal against ABM is the fact that it admits zero or negative prices. To address that, this issue of limited liability, one way to model the stock price is simply the stock price of a limited liability company. Well, the stock price of a limited liability company is the stock price of an unlimited liability company plus a zero strike put. And so just by way of example, if I have the value of the stock, if there's no limit to liability with these other parameters, the underlying stock is trading at $10, but the limited liability company is trading at $17. And so this, and with the strike price of zero, the stock of the unlimited plus a put is equal to a call option. And the argument is that, well, the value of the call is greater than the value of the stock. But what's missing is the recognition that the value of the call option, which is simply just the value of a limited liability stock. And so it has not been true throughout all history that stocks enjoy limited liability. This is a recent phenomenon in the mid-1800s in London and some in Europe, and then eventually in the United States. And so my takeaway from this is I can now value limited liability, the economic value of being able to limit liability, and do analysis that way. So by way of example, if I take this data, $10 unlimited liability stock with the remaining parameters, I get a call price of $11.92 and a put price of $11.43. Again, that the call price is above the unlimited liability value because I'm willing to pay more for a company that has limited liability. And so the value of a limited liability company with a zero strike put that we looked at previously is $17.35. And so you can basically look at a variety of different ways of viewing this. An unincorporated company has a linear payoff. A zero strike or incorporated company is going to have this features of a call option, but a ABM call struck at 10 is going to have a diagram that looks like this, which is always below the limited liability stock. And so once you incorporate a zero strike put, the limited liability is addressed well, and it satisfies all the boundary condition criteria that Samuelson was concerned about. And so the zero strike put clearly has enormous value as you go negative. If a company ends up doing environmental damage or there is some health issue where the company's facing a massive legal liability, such as the tobacco industry, the fact that these tobacco companies' stock enjoyed limited liability suddenly became incredibly valuable. And so as I'm rather entrepreneurial and enjoy working with startups, and one of the wonderful things about a startup company is that it enjoys limited liability, assuming that it has its legal documents in order. And so if you think about an unincorporated stock with a zero strike put and a strike price of 10 with limited liability, the put struck at 10 limits out at $10 because of the limited liability of the company. And so it's very straightforward to modify the limited liability company as a unlimited liability company plus a zero strike put, and then all the other option conditions fall right into place. And so If SUL is the stock of the unlimited liability company, SLL is the stock of the limited liability company, again, the stock of the limited liability is going to equal to the stock of the unlimited liability plus a put. GBM, these two will be equal. Why? Because what's the value of a zero strike put when the stock can never hit zero? It's zero. With ABM, limited liability has positive value, or that zero strike put has positive value. Therefore, the stock of limited liability is greater than the unlimited. And this turns out to be important in explaining why companies have so many separate legally incorporated entities. Note that if the ratio between the stock of the unlimited company divided by the standard deviation is less than about 3.1, then the put value is less than a penny. So most of the time it's not worth that much. Just by way of reminder, the ABM option values, they have this symmetric time value depiction. Rather than being positively skewed, it's symmetric. And remember, the empirical data has this negative skewness. So some of the key quantitative finance materials, we'll go over these quickly. The terminal distribution is normal, and the rest of the assumptions are as they were with GBM. The dividends will be addressed. That's the same as GBM. The ABM model does look different. There's a PDF and a CDF within the equation, but this is easy to code up in R without any problems, and the code is provided. And the dividend yield only model looks something like this. Easy to incorporate a dividend yield. The derivation follows directly with the GBM. The only difference is, notice there's no S term in the noise, and therefore to do the hedge ratio, you do the same sort of argument. You create a hedge portfolio. Again, the mu drops out, and basically the assumption is that the underlying grows at the risk-free rate. The PDE looks slightly different. There's no S term right here, but it's easy to prove that the ABMOVM model presented in this chapter is consistent with this PDE. And so in summary, ABMOVM, at least from my perspective, is a reasonable alternative to GBMOVM. It's good to have an arsenal of different models, and depending on what your needs are. And we looked at comparing and contrasting with GBM, and from where I sit, there's a host of positive benefits from considering ABMOVM, and I would recommend that you explore it. The R code provided with this particular model follows very carefully the GBM case, and so I'd recommend that you spend some time comparing and contrasting these two models, and give some deep consideration to the ABMOVM